Welcome to Iron Financial. Our mission is simple: to forge stronger portfolios by stress testing company fundamentals and cutting straight through the market weakness. Today, we're grabbing our hard hats and safety vests because we are inspecting a company in the middle of a truly radical transformation. Bit Digital, ticker BTBT. They have literally torn their old business model down to the studs, and now they're attempting one of the most aggressive strategic pivots we have ever seen in the digital asset space. So the question we have to answer today is whether they've actually built a solid new structure with a steel spine, or if it's just a house of cards sitting on a foundation of sand. All right, let's get into it. The entire story, the whole puzzle we need to solve, it starts right here with this glaring paradox on your screen. So for the full fiscal year 2025, Bit Digital reported total revenue of $113.6 million. Now that's a 5% increase year over year. In a tough market, any growth is good growth. You see a top-line number like that and you might think, okay, pretty steady ship. But then your eyes drift over to the right side of the slide. And in that exact same period, they posted a net loss of $80.3 million. And let me be absolutely clear. This isn't just a small dip. This is a catastrophic swing from a net income of $28.3 million the year before.
Whoa, hold on a second. Pump the brakes. Let me get this straight. You're telling me their revenue actually went up, but their profitability didn't just take a hit, it completely fell off a cliff. They went from making nearly $30 million to losing over $80 million. That's a $110 million negative swing on the bottom line? How is that even possible? That kind of math just doesn't compute. That's not just a bad quarter. That's a 5-alarm fire burning through the balance sheet. This is the exact kind of number that makes investors stampede for the exits. Something here doesn't add up, and that's exactly what we're here to figure out.
And to understand that massive swing, you first have to understand the rebuild they're undertaking. You can't properly inspect a new building without first understanding exactly what they tore down to make room for it. So our first stop is to analyze the controlled demolition of their old business model, commodity Bitcoin mining. They didn't just renovate the place. They took a wrecking ball to what was once their core operation, the very business that put them on the map in the first place. And when I say demolition, I mean a complete and total leveling of the site. Just look at these numbers. Revenue from their digital asset mining, their legacy business, it plummeted to just $27.3 million in 2025. Now that's down from $58.6 million the year before. That's a 53% drop. You just don't see a decline that steep by accident. This wasn't a case of letting a business line wither on the vine. They actively took it apart piece by piece. This was a deliberate strategic choice to clear the entire lot for something brand new. Okay, a controlled demolition sounds like great corporate spin, but isn't it also possible they just got absolutely crushed in the Bitcoin mining game? I mean, a 53% revenue drop is a crater, not a dip. We all know network difficulty has been rising relentlessly, and the competition from massive, low-cost operators is just brutal. Maybe the foundation of their old business simply collapsed under its own weight, and they're just spinning this as a strategic choice after the fact. Are they really rebuilding by choice, or are they just scrambling to build something, anything, on the rubble of a failed business?
That is absolutely the right question to ask. That's the healthy dose of skepticism we need here. But all the evidence we have points squarely to a deliberate, thought-out strategy. They've been systematically reducing their active hash rate, winding it all the way down to just 1.5 exahash per second, which is a mere shadow of its former self. And even more importantly, they've stated right in their filings that they don't expect to invest any meaningful growth or maintenance capital into this segment going forward. They are effectively turning off the lights, locking the doors, and walking away from the factory. And management has been crystal clear about why.
Now, what's really fascinating about this slide is that this is the rationale coming straight from the top. The CEO, Sam Tabar, said, and I'm quoting here, "We exited businesses that no longer represented an efficient use of capital." Now, notice, he's not saying the business failed. He's saying it became inefficient, a poor use of shareholder money. In their view, Bitcoin mining had basically become a rusted-out piece of machinery with diminishing returns. So their goal wasn't to try and patch it up, but to scrap it for parts and reinvest that capital into new infrastructure they believe will generate far better returns, or as he puts it, compound over time. Okay, so with the old factory floor completely cleared, they laid out a brand new blueprint. This is the absolute core of their transformation, and it's the most critical part of our analysis today. Let's inspect the new construction. They're rebranding themselves from a simple commodity producer, a Bitcoin miner, into what they are calling a strategic asset company. This is the new framework they're building from the ground up. Okay, stop right there. Strategic asset company. That sounds exactly like the kind of high concept corporate jargon that a consultant gets paid six figures to come up with on a whiteboard during a brainstorming session. I mean, it sounds impressive, sure, but what does it actually mean for me, the investor? Are they just another holding company with a fancy new name passively sitting on a pile of assets? Or are they actually building a real, revenue generating business with some operational muscle? I need to know if this is a solid blueprint or just some fancy architectural drawings with no real substance behind them. And that's the crucial point, because it's not just talk. When you cut through all that jargon, the blueprint reveals two very distinct, very solid pillars that form this new foundation. The first pillar is what they call economic infrastructure. Now, in simple terms, this is their massive all-in bet on the Ethereum ecosystem. They don't just buy and hold ETH, they actively use it through staking to generate a steady yield. The second pillar is intelligence infrastructure. This is their big play on the AI boom, and it's being executed through their majority ownership stake in a separate publicly traded company called WhiteFiber. So what you have are two distinct engines for growth, one powered by crypto finance and the other powered by AI compute. And this revenue mix from 2025 shows you exactly how those new pillars are already shouldering the load. Look at it. The old business, digital asset mining, that's the $27.3 million slice. Now look at the new businesses. Cloud services, which is their main AI infrastructure play, brought in $68.8 million. Colocation services, another part of that same AI pillar, added another $8.9 million. And their Ethereum staking operation, the economic infrastructure pillar, generated $7 million. You can literally see the transition happening right here in real time. The new structure is already generating more than double the revenue of the one they just finished tearing down. Now let's drill down into the structural integrity of these new pillars. Pillar 1, the AI and intelligence infrastructure. Revenue from their cloud services jumped from $45.7 million to $68.8 million in just a single year. That is a solid 50% growth rate. This isn't some speculative pie-in-the-sky revenue. This is real, recurring revenue from one of the highest growth sectors on the entire planet. This is the first steel beam of the new construction, and believe me, it looks strong. But it gets even more dramatic than that. Just look at the colocation services, another key component of that same AI infrastructure play. This segment absolutely exploded. It went from just $1.4 million in revenue in 2024 to $8.9 million in 2025. That is a staggering 555% increase. Now, it's a smaller piece of the pie for now, but with that kind of growth trajectory, it's clear this part of the business is doing some very serious heavy lifting for the entire structure. And the second pillar, their Ethereum strategy, is showing the exact same impressive tensile strength. Their staking revenue climbed from $1.8 million to $7 million. That's 287% growth. This is the proof of concept for their whole economic infrastructure model. They're not just holding ETH passively, they are putting it to work and generating a real, growing cash flow from it. This is what active management looks like.
Okay, fine, I see it. The growth is undeniable. 50%, 555%, 287%. Those are strong, powerful numbers. I will absolutely give you that. I see the steel beams going up and they look solid. But you still haven't answered my original question. You've shown me this brand new skyscraper going up, but you started this whole thing by telling me the project is $80 million in the red. If all these new businesses are booming, where in the world did that massive loss come from? It feels like we're admiring the view from the top floor without bothering to check for massive cracks in the foundation.
You're absolutely right. And that is the most important question of all. All the operational growth in the world doesn't matter one bit if the foundation it's built on is unstable. So now it's time to do exactly that. We're going to take this new structure and we're going to put it through a rigorous balance sheet stress test. We're going to find the source of that $80 million loss. It's time to find the cracks. All right, let's get under the hood of this thing. On the surface, everything looks pretty robust. As of the end of fiscal 2025, they had $118.4 million in cash and equivalents. That's a very strong cash position, up from $95 million the year before. That's a solid cushion to absorb shocks. Their stake in WhiteFiber was valued at over $427 million. But here's the number we need to bore down on. $415.7 million in digital assets, almost all of which is Ethereum. That is a massive concentration in a single, notoriously volatile asset. This is the fault line running directly underneath their foundation. This is where all the seismic risk is concentrated. And this next slide, well, this is the most critical slide of our entire analysis. This is the stress test in a single, brutal image. This one slide tells you everything you need to know about the risk here. On the left, you see their average acquisition price for all the Ethereum they hold, approximately $3,045 per coin. That's their cost basis. Now look to the right. You see the market price of ETH as of February 28, 2026, $1,965. They are significantly, deeply underwater on their primary balance sheet asset. This is the crack in the foundation, clear as day. So now we can finally answer the question that hooked us right at the beginning. That $80.3 million net loss was not an operational failure. I want to be extremely clear about that. Their new businesses, as we just saw, are growing explosively. The entire loss, every single dollar of it, can be explained by this one line item: a massive $85 million negative swing in the mark-to-market valuation of their digital assets. In 2024, they booked a paper gain of over $55 million on their crypto. In 2025, they booked a paper loss of over $29 million. That swing completely wiped out all of their impressive operational progress and then some. Their profitability is completely and totally hostage to the price of Ethereum. But to be fair, they aren't just sitting on this ETH like some passive retail investor hoping for the best. As we see here, they're actively staking nearly 89% of their total holdings. It is a productive asset. The report says they're earning about a 2.7% annualized yield from it, so they are generating income, and that income is supposed to offset some of this price risk. The fundamental question for an investor, though, is whether that relatively small yield is enough of a shock absorber to protect the portfolio when the price of the underlying asset can drop by more than a third. It feels like trying to patch a giant crack in a dam with a little piece of chewing gum. It's better than nothing, but it's not going to stop a flood.
That's the perfect analogy. The yield provides a trickle of cash flow, but the risk is a potential tidal wave of capital depreciation. We've seen the demolition, we've inspected the new construction, and now we found the fault line. We have all the pieces of the puzzle.
Exactly. The core tension of this entire investment thesis is now laid completely bare. We've seen the demolition of the old, inefficient mining model. We've inspected the blueprints, and we've seen the impressive triple-digit growth of their two new pillars in AI and staking. But we've also run the stress test, and we've located a major structural vulnerability in the foundation. All the evidence is now on the table, so it's time to weigh the strengths against the weaknesses and issue the iron financial verdict. Is Bit Digital a high-tech fortress or a beautifully designed trap? The bull case is compelling, and it's built entirely on the execution of their stated strategy. First, they made a clear, decisive pivot away from an inefficient business. That takes real discipline and foresight. Second, they've ignited explosive triple-digit growth in their new revenue pillars. This isn't theoretical future growth, it's already on the books. Third, they have a very strong cash position of over $118 million, which gives them a significant buffer to weather market storms and continue executing their plan. Fourth, through WhiteFiber, they own a majority stake in a pure-play AI infrastructure company, a red-hot sector with a long runway for growth. And finally, as we've discussed, they are actively generating yields on their primary asset, not just letting it sit there idle. The bulls see a company that has successfully rebuilt its frame around the high-growth sectors of tomorrow. But the bear case is just as powerful, and it's all about that unstable foundation. It doesn't matter how well-designed the superstructure is if it's built on the volatile, shifting ground of the crypto market. The company's profitability is not tied to their operational execution. It's completely and utterly tied to the price of Ethereum. Their high acquisition cost of over $3,000 per ETH puts them in a very precarious position, meaning ETH has to rally more than 50% from current levels just for them to break even on their holdings. And as we saw, one bad year for crypto prices completely erased all their impressive growth and dragged them into a massive loss. The entire business model is exposed to seismic shocks from the crypto market that are completely outside of their control. The bears see a well-run operational company whose fate is ultimately tied to a roulette wheel. Lead analyst, management for their part, would point to their experience as their primary defense against that volatility. This quote here says it all. We have operated through multiple market cycles. Volatility is not new to us. What they're arguing is that they have the discipline, the balance sheet, and the institutional fortitude to ride out these waves and focus on long-term execution and compounding value.
Market skeptic. And they may be right. They've certainly survived crypto winters before, I'll give them that. But they survived them as a Bitcoin miner, which is a completely different business. They've traded the distributed risks of mining difficulty, energy costs, and geographic regulation for the singular, massive, concentrated risk of a single asset's price. Past performance in a different business model doesn't guarantee future stability in this new one. It's an entirely different kind of earthquake they have to prepare for now. The old playbook is completely irrelevant.
And so, the crucial point is this.
our inspection is complete. Bit Digital has successfully executed a dramatic and genuinely impressive operational turnaround. They have demolished their old business and forged a brand new frame built on the high-growth pillars of AI compute and Ethereum infrastructure. The operational numbers are strong, and they show real execution. However, this new gleaming structure is built on a foundation that is fundamentally and entirely exposed to the volatility of the crypto markets. This makes Bit Digital less of a pure play on AI or Ethereum staking and more of a high-risk, high-reward leveraged bet on the future price of Ethereum itself, with a nice AI business attached. The operational growth is the safety net, but the primary driver of shareholder value, for better or for worse, will be the price of ETH.
Market skeptic, which means you're not just betting on management's ability to run their cloud and staking businesses. You're making a massive, directional bet on a single cryptocurrency. The operational success is almost a secondary factor to the crypto market's whims.
Exactly. And so the final question that every single investor has to ask themselves is the one right there on your screen. Bit Digital has forged a new frame, but is it strong enough to survive the next market earthquake? And for investors considering this stock, that's the billion-dollar question.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.